Welcome to the WorldWire Update, White. Don't forget to subscribe and click the bell icon for more updates and thrilling short scenes. On March 27, 2025, President Trump shocked the global auto industry by announcing sweeping 25% tariffs on imported cars and parts from Canada, Mexico, Asia, and Europe. The announcement came unexpectedly, sending shockwaves through boardrooms and factory floors alike, and immediately raising questions about the future of international trade and manufacturing. The tariffs, set to hit vehicles in early April and parts in May, sent legacy automaker stocks tumbling and rattled Wall Street. Investors scrambled to reassess their positions, as financial news outlets flashed red with plunging auto stocks. The uncertainty rippled through the markets, affecting not just automakers, but suppliers and related industries as well. Automakers like Ford and GM, whose operations depend on complex global supply chains, suddenly faced existential threats to their business models. The prospect of higher costs and disrupted logistics forced executives to consider drastic changes, from shifting production to renegotiating supplier contracts, all while trying to reassure anxious employees. Meanwhile, Tesla and Rivian, with more localized U.S. production, saw their fortunes rise as investors bet on their resilience. Their business models, less reliant on international parts, suddenly looked like a safer bet, and their stock prices surged in the days following the announcement. President Trump warned of even higher tariffs if Canada or the EU retaliated, plunging the industry into even deeper uncertainty and making long-term planning nearly impossible. Companies were left in limbo, unsure how to adapt to a rapidly changing trade landscape. While the tariffs were pitched as a way to bring jobs back to the U.S., industry leaders warned that the deeply integrated North American market couldn't be untangled overnight. Decades of cross-border cooperation and investment had created a system where parts and vehicles crisscrossed borders multiple times before reaching consumers. The move risked unraveling decades of cooperation, threatening not only workers and consumers, but the very companies that had built their futures on international collaboration. As uncertainty deepened, the entire industry braced for a turbulent new era. The tariff's most immediate impact? It hits right where it hurts most for Americans: their wallets and their ability to buy a new car. Higher prices for American car buyers are now the new normal, as sticker shock becomes a common experience at dealerships across the country. Even vehicles assembled in the U.S. depend on a complex web of imported parts, many of which cross borders several times during production. Now every crossing is taxed, compounding costs at each step and making cars more expensive to build. Analysts warn that new car prices could surge by thousands of dollars, putting ownership out of reach for many families who were already stretching their budgets. The dream of a new car is slipping away for more Americans. Automakers, squeezed by rising costs, may be forced to drop lower-margin models like compact cars, shrinking consumer choice, and focusing production on higher-priced trucks and SUVs that fewer people can afford. The North American supply chain, once a model of efficiency and integration, is now fragile and unpredictable. Union leaders warn that if the situation continues, the entire industry could grind to a halt within weeks, putting thousands of jobs at risk. Disruptions threaten to shut down assembly lines as shortages of critical parts ripple through the system, leaving workers idle and factories eerily quiet. Moving all production to the U.S. isn't a quick fix. Building new plants takes years, requires billions in investment, and faces its own set of regulatory and labor challenges. With policy uncertainty looming and no clear end in sight, automakers are paralyzed, caught between absorbing tariff costs, passing them to consumers, or making massive, risky investments that may not pay off. The result? A market teetering on the brink, with both companies and consumers facing tough choices, and the future of the American auto industry hanging in the balance. Ford's CEO called the tariffs devastating, echoing widespread alarm from industry leaders. The new tariffs have sent shockwaves through the automotive sector, causing significant concern among executives. Decades of cross-border integration are now at risk, with US, Canadian, and Mexican factories suddenly divided by new barriers. The seamless flow of parts and vehicles is now disrupted, threatening the efficiency of the entire supply chain. Some automakers are eyeing Canada for more production, but shifting operations is costly and complex. The logistical challenges and financial burdens are immense, making it a daunting task for many companies. Tesla, with its vertically integrated US factories, is less exposed. Its stock surges as rivals scramble. Tesla's strategic advantage becomes more apparent as it navigates these turbulent times with relative ease. The tariffs, meant to boost American manufacturing, may actually strengthen Tesla's dominance. As other automakers struggle, Tesla's market position grows stronger, highlighting the unintended consequences of the tariffs. Legacy automakers face a dilemma: absorb costs, pass them to consumers, or attempt a massive overhaul of their supply chains. Each option carries significant risks and potential downsides, making decision-making incredibly challenging. The industry is locked in a high-stakes standoff, with no easy way out. Negotiations are tense, and the future remains uncertain as companies weigh their options. Every major automaker is now rethinking its entire North American strategy. Strategic planning sessions are in full swing as companies try to adapt to the new reality. The future of the industry hangs in the balance. The decisions made in the coming months will shape the automotive landscape for years to come. Amid the tariff chaos, a different revolution is underway. Tesla's North American charging standard, NACS, is becoming the industry norm. Ford led the charge, giving its EV owners supercharger access and equipping new models with NACS ports. Soon, GM, Rivian, Volkswagen, Hyundai, BMW, Toyota, and others followed, cementing NACS as the new standard. By late 2025, nearly every major automaker had adopted NACS, ending the charging standard war. This shift solves a major pain point: range anxiety, by giving EV buyers access to the most reliable charging network. The unified standard makes EV ownership simpler and more appealing, accelerating the electric transition. It's a game changer for the industry and consumers alike. The NACS adoption has unexpectedly boosted Canada's role in the North American auto market. Automakers now launch new EVs with NACS ports in both the US and Canada, making Canada central to the EV rollout. As tariffs bite, Canadian leaders respond with condemnation and a $2 billion fund to support their auto industry. The US and Canadian auto sectors are deeply intertwined. Tariffs threaten to disrupt decades of partnership. Canadian auto workers brace for job losses and plant closures as companies struggle with rising costs. Canada now stands at a crossroads, a key EV partner, but also a target of US protectionism. The coming months will test Canada's resilience and its place in the global EV market. Its response could shape the future of North American auto manufacturing. The tariffs have split auto workers' unions across the border. In the US, the UAW supports the tariffs, hoping they'll bring jobs back home. For American union leaders, higher import costs are a lever to force companies to invest in US factories. Canadian unions see the tariffs as an existential threat, warning of immediate job losses and supply chain chaos. The integrated industry means a slowdown in Michigan spells layoffs in Ontario. The UAW is betting on long-term gains, but Canadian workers face immediate peril. This divide highlights the unintended consequences of protectionism in a deeply connected industry. Workers on both sides are caught in the crossfire of a policy war. The new tariffs collide with a patchwork of US policies, deepening industry confusion. Billions have been invested in domestic EV plants, spurred by the Inflation Reduction Act, now threatened by Trump's opposition to the law. Automakers face rising costs from tariffs while federal incentives for EVs hang in the balance. Meanwhile, states like California and New York are mandating a shift to all-electric vehicles by 2035. Automakers must invest in EVs to meet state rules, even as federal policy grows more hostile. The result? A chaotic landscape where companies must juggle conflicting signals from Washington and state capitals. Strategic planning is nearly impossible, with no clear national vision for the industry's future. The lack of coherence threatens both investment and innovation. As the dust settles, the auto industry faces a future clouded by risk and uncertainty. Car prices are set to rise sharply, squeezing buyers and pushing many out of the new car market. Workers face layoffs as supply chains falter, even as unions hope for long-term job gains. Automakers must choose: absorb costs, reshore production, or cut models. None are easy options. The tariffs could accelerate Tesla's rise and wound legacy automakers, while straining US relations with Canada and Mexico. For drivers, the outcome is likely higher prices, fewer choices, and a market in turmoil. The decisions made now will shape what we drive, how much we pay, and where our cars are built for years to come.